Have you ever wondered why some people seem to build wealth effortlessly while everyone else waits for the perfect time to invest? History shows that the biggest fortunes in real estate are rarely made by following the crowd. Instead, they are built by people who recognize opportunities before they become obvious. Right now, while headlines continue to debate whether the housing market will rise, fall, or remain stagnant, a growing number of experienced investors are quietly purchasing homes across the United States. They're not acting on emotion or speculation. They're following data, long-term trends, and decades of market experience. The surprising question isn't why they're buying, it's why so many people are still waiting. In today's video, we'll uncover the real reasons smart investors are moving into the housing market before everyone else, explore the economic forces shaping their decisions, and reveal why today's uncertainty may actually become tomorrow's greatest opportunity. For many first-time buyers and everyday families, the current housing market feels confusing. Mortgage rates remain higher than they were just a few years ago. Home prices in many regions are still near record highs, and economic news changes almost every week. One day experts predict a market slowdown, while the next day they warn about another housing shortage. This uncertainty causes many people to postpone buying a home because they believe prices will eventually crash. But experienced investors often see uncertainty differently. Instead of asking whether today feels comfortable, they ask whether today's conditions create opportunities that others are too afraid to recognize. That difference in mindset has separated successful investors from average buyers for generations. One of the biggest reasons smart investors are buying now is simple. They understand that real estate moves in cycles, not straight lines. Every housing market experiences periods of rapid growth, slower appreciation, temporary corrections, and eventual recovery. Investors know that trying to perfectly predict the bottom of the market is nearly impossible. Waiting for absolute certainty usually means paying a much higher price later. By the time everyone agrees that it's a great time to buy, the best opportunities have often disappeared. Instead of chasing headlines, successful investors focus on long-term value, knowing that patience often rewards those who buy quality properties before public confidence returns. Another important factor is the ongoing housing supply shortage across many parts of the United States. Over the past decade, home construction has struggled to keep pace with population growth and household formation in many markets. Even when demand temporarily slows because of higher interest rates, the limited supply of available homes continues to support property values in many areas. Investors understand that real estate prices are influenced not only by borrowing costs, but also by the simple balance between supply and demand. When there are not enough homes for the number of people who need them, prices often remain more resilient than many expect. Demographic trends also play a major role in today's investment decisions. Millions of younger adults are entering their prime home buying years. At the same time, migration continues towards states and metropolitan areas offering stronger job markets, lower taxes, and better affordability. Cities experiencing population growth often generate increased demand for both homeownership and rental housing. Smart investors carefully study where people are moving, rather than focusing only on where prices have already increased. They understand that population growth often creates sustained demand that can support property values for many years. Another reason experienced investors are acting now is the rental market. Even with higher mortgage rates, many Americans continue renting because buying remains difficult for some households. This strong rental demand creates opportunities for investors seeking long-term cash flow rather than quick profits. Instead of relying entirely on rising home prices, many investors purchase properties that generate steady rental income, while also benefiting from potential long-term appreciation. This combination of monthly income and future value growth has made residential real estate one of the most attractive long-term investment assets for decades. Inflation is another piece of the puzzle that many people overlook. During periods of elevated inflation, the purchasing power of cash gradually declines. While every investment carries risk, real estate has historically been viewed as one asset that can help preserve wealth over long periods, because property values and rental income have often increased alongside inflation, although not always in every market or every year. Investors recognize that owning tangible assets may provide advantages over holding large amounts of cash during inflationary environments. Rather than allowing money to lose purchasing power, they prefer investing in assets that have the potential to grow over time. Smart investors also understand something that emotional buyers often forget. Successful investing is rarely about today's headlines. News organizations naturally focus on dramatic stories because they attract attention. Predictions of market crashes, economic disasters, or housing bubbles generate more clicks than discussions about steady long-term growth. Experienced investors separate short-term noise from long-term fundamentals. They examine employment trends, local economic development, infrastructure projects, business investment, school quality, transportation improvements, and neighborhood growth before making decisions. While others react emotionally to every headline, investors quietly analyze facts that may influence property values over the next 10 or 20 years, instead of the next 10 or 20 days. Perhaps the most overlooked advantage belongs to buyers who enter the market when competition is lower. During periods of uncertainty, fewer buyers actively search for homes. That often means more negotiating power, less bidding competition, greater flexibility from sellers, and increased opportunities to secure favorable purchase terms. Investors recognize that buying during quieter markets can sometimes produce better long-term outcomes than competing in overheated markets where emotions drive prices far above underlying value. They understand that opportunity often appears when confidence is at its lowest, not when excitement reaches its highest. Of course, this doesn't mean every property represents a great investment or that every market will perform the same way. Successful investors never assume that all homes will automatically increase in value. Instead, they carefully evaluate local market conditions, neighborhood quality, employment growth, future development plans, rental demand, property condition, financing costs, and realistic long-term returns before making any purchase. Their success comes from disciplined research, careful analysis, and patience, not from blind optimism or gambling on quick profits. And as you'll discover in the next part of this video, the economic signals they're watching today may explain why many believe the next decade could create remarkable opportunities for prepared buyers, while those waiting on the sidelines continue searching for the perfect moment that may never arrive. Now that we understand why experienced investors are entering the market despite uncertainty, the next question is even more important. What exactly are they seeing that most people are missing? The answer lies in a combination of economic indicators, demographic trends, and long-term planning. While many buyers focus only on today's mortgage rates or tomorrow's headlines, professional investors look years into the future. They know that real estate is rarely about making a quick profit. Instead, it is about positioning yourself where future demand is likely to be stronger than it is today. That forward-looking mindset is exactly what separates successful investors from those who spend years waiting for the perfect opportunity. One of the first indicators investors monitor is the job market. Strong employment growth often leads to stronger housing demand because people move where opportunities exist. When companies expand, build new offices, or relocate operations to a city, thousands of workers follow. Those workers need places to live, whether they rent or buy. Over time, growing employment can increase demand for housing, supporting both home values and rental income. This is why experienced investors spend just as much time studying local economies as they do studying home prices. They understand that a beautiful house in a declining job market may not perform as well as an average home in a rapidly growing city. Infrastructure is another factor that receives far less attention than it deserves. New highways, airports, public transportation systems, hospitals, universities, technology parks, and commercial developments often transform entire neighborhoods over several years. Before these projects are completed, property prices in surrounding areas may still be relatively affordable. Investors who identify these developments early often position themselves ahead of broader market interest. By the time new businesses open and new residents arrive, property values may already be benefiting from increased demand. This patient approach allows investors to capitalize on long-term growth, rather than chasing markets that have already experienced rapid appreciation. Another reason investors remain confident is the continuing evolution of remote and hybrid work. Millions of Americans are no longer required to live near expensive downtown business districts. Instead, many are choosing suburban communities and smaller metropolitan areas that offer larger homes, lower living costs, and improved quality of life. This migration has reshaped housing demand across numerous regions. Investors recognize that changing lifestyles can permanently alter which communities experience population growth. Rather than assuming yesterday's hottest markets will always remain on top, they continuously analyze where people are actually choosing to relocate. Interest rates also play a more complex role than many people realize. Higher mortgage rates certainly reduce affordability for some buyers, but experienced investors know that interest rates do not remain constant forever. Some buyers accept current financing costs because they believe they can refinance if rates decline in the future, although future rate movements can never be guaranteed. More importantly, investors focus on whether a property represents good long-term value instead of obsessing over short-term borrowing conditions. If a home meets their investment criteria and generates sustainable returns, today's financing environment becomes only one part of a much larger financial picture. Another strategy used by successful investors is diversification. Rather than concentrating all of their money into a single expensive property, many spread investments across different neighborhoods, property types, or even different states. This approach reduces exposure to any one local market while creating multiple opportunities for appreciation and rental income. Diversification cannot eliminate risk, but it can help investors manage uncertainty more effectively over long investment periods. They understand that every market experiences ups and downs, which is why building a balanced real estate portfolio often proves more resilient than relying on one high-risk investment. Technology has also changed how investors analyze opportunities. Today, they have access to detailed market data, neighborhood statistics, population trends, school ratings, rental demand, property tax information, and economic forecasts that were difficult to obtain just a generation ago. Instead of making decisions based purely on instinct, many combine experience with data-driven analysis. They compare historical appreciation, evaluate inventory levels, examine average days on market, monitor construction activity, and assess local business expansion before purchasing a property. This disciplined research process helps reduce emotional decision-making and increases confidence in long-term investment choices. Perhaps the greatest lesson from experienced investors is that they rarely allow fear to control their decisions. Every economic cycle produces uncertainty. There are always concerns about inflation, interest rates, recessions, elections, or global events. Yet history has repeatedly shown that people who consistently invest based on careful research instead of emotional reactions often place themselves in stronger financial positions over time. That does not mean every investment succeeds or that losses are impossible. Rather, it means disciplined investors accept that uncertainty is a normal part of investing and prepare accordingly, instead of allowing it to keep them permanently on the sidelines. However, smart investors are not blindly buying every home they see. They calculate expected expenses, maintenance costs, insurance, taxes, financing payments, vacancy risks, and realistic rental income before making an offer. They negotiate carefully, maintain financial reserves for unexpected repairs, and avoid stretching beyond what they can comfortably afford. Their confidence comes from preparation, not overconfidence. They understand that real estate rewards patience, planning, and disciplined execution, far more than impulsive decisions driven by excitement or fear. So, while many people continue asking whether now is the right time to buy, experienced investors are asking a completely different question. Which properties have the strongest long-term potential, regardless of today's headlines? That subtle difference changes everything. Instead of trying to predict every short-term market movement, they focus on acquiring quality assets capable of creating value over many years. And in the final part of this video, we'll explore the biggest risks every buyer should understand, the mistakes that can destroy returns, and why the next decade could present extraordinary opportunities for those who prepare wisely, rather than simply waiting for perfect conditions that may never arrive. Before rushing to buy a home simply because experienced investors are entering the market, it's important to understand one critical truth. Successful investing is never about following trends blindly. Every real estate purchase involves risk, and the smartest investors are often the ones who spend the most time preparing before they ever sign a contract. They know that even in a strong market, a poor investment can remain a poor investment for years. That's why they evaluate every opportunity carefully, balancing potential rewards against realistic risks. They understand that wealth is built not by avoiding all risk, but by managing risk intelligently. and making decisions based on facts rather than emotions. One of the biggest mistakes many buyers make is assuming that home prices always rise quickly. While real estate has historically appreciated over long periods in many markets, appreciation is rarely smooth or guaranteed. There are years when prices grow rapidly, years when growth slows dramatically, and periods when some local markets even experience temporary declines. Experienced investors expect these cycles. Instead of becoming discouraged by short-term fluctuations, they focus on whether the underlying reasons for owning the property remain strong. If the location continues attracting jobs, businesses, residents, and investment, temporary market volatility often becomes easier to tolerate as part of a long-term strategy. Cash flow is another principle that separates professional investors from emotional buyers. Rather than relying entirely on future appreciation, many investors prefer properties that can generate steady rental income while covering operating expenses. Positive cash flow provides financial flexibility during uncertain economic periods and reduces dependence on constantly rising home prices. Even when appreciation slows, consistent rental income can help support the overall investment. This balanced approach reflects a mindset built around sustainability instead of speculation. Location continues to be the single most important factor in real estate investing, and that reality is unlikely to change anytime soon. A well-maintained home in an area with expanding employment opportunities, improving infrastructure, quality schools, convenient transportation, and growing population demand often has stronger long-term potential than a larger or more luxurious property in a declining market. Experienced investors understand that while homes can be renovated, expanded, or modernized, the surrounding location cannot be changed. That is why they often spend more time researching neighborhoods than comparing kitchens, bathrooms, or cosmetic upgrades. Financial discipline also plays a major role in long-term success. Smart investors avoid overextending themselves simply because lenders approve larger loans. They maintain emergency reserves, account for maintenance costs, property taxes, insurance premiums, unexpected repairs, and periods of vacancy when calculating returns. They prepare for situations where market conditions may become less favorable, instead of assuming everything will always go according to plan. This conservative approach allows them to weather economic uncertainty while continuing to hold valuable assets through changing market cycles. Another lesson from experienced investors is the importance of patience. Real estate is rarely a path to overnight wealth. Most successful portfolios are built gradually over many years through consistent decision-making, disciplined saving, careful property selection, and long-term ownership. While social media often highlights dramatic success stories, the reality is that sustainable wealth usually grows quietly through compound appreciation, rental income, mortgage principal reduction, and increasing property value over extended periods. Investors who understand this principle are less likely to panic during temporary market slowdowns, because they remain focused on long-term objectives rather than short-term headlines. Looking ahead, several long-term trends could continue influencing the housing market. Population growth in certain regions, ongoing infrastructure investment, technological development, business expansion, and changing lifestyle preferences may create opportunities in communities that are still relatively affordable today. At the same time, limited housing supply in many growing areas could continue supporting demand over the coming years, although local markets may perform differently depending on economic conditions and regional factors. This is exactly why experienced investors avoid making broad assumptions about the entire housing market. Instead, they analyze each city, neighborhood, and property on its own merits. Perhaps the most valuable lesson is that opportunity often appears when confidence is low. Throughout history, many of the strongest long-term investments have been made during periods of uncertainty, when fear discouraged large numbers of potential buyers from acting. That does not mean every uncertain market creates great opportunities, nor does it guarantee future returns. It simply highlights an important principle. Investors who combine patience with careful research are often better positioned to recognize value before it becomes obvious to everyone else. By the time public optimism fully returns, competition usually increases, and many of the best opportunities have already been claimed. So, are smart investors buying homes before everyone else? In many cases, yes, but not because they possess secret information or can predict the future with certainty. They are buying because they understand market cycles, study economic fundamentals, evaluate long-term demand, manage risk carefully, and remain disciplined when others become emotional. Their advantage comes from preparation, not prediction. While many people continue waiting for perfect conditions, experienced investors recognize that perfection rarely exists in financial markets. Instead, they search for properties with strong, long-term potential and make informed decisions based on evidence rather than fear or excitement. As you think about your own financial future, remember that the most successful investment decisions are rarely driven by headlines alone. They are built on education, patience, realistic expectations, and consistent action over time. Whether you're planning to buy your first home, invest in rental property, or simply understand how the housing market works, learning to think like a long-term investor can completely change the way you view opportunity. The question isn't whether the market will ever become perfectly predictable. It never will. The real question is whether you'll be prepared to recognize opportunity when it appears, while everyone else is still waiting for certainty. If you enjoyed this breakdown and want more in-depth analysis on the U.S. housing market, real estate investing, and the economic trends shaping tomorrow's opportunities, make sure to like this video, subscribe to the channel, and turn on notifications so you never miss our next deep dive. Thank you for watching, and I'll see you in the next video.